Paying taxes can, in fact, feel more like an art than a science, and it's an area rife with emotion and often fear. We're here to remove some of the confusion and position you to operate from a place of strength and knowledge. This video is about how to legally reduce your self-employment taxes, so you're not inadvertently sacrificing funds just because you didn't know better. In short, tax avoidance versus tax evasion. The term tax avoidance sounds a bit sinister, but it isn't the same as tax evasion. One's legal and one isn't, as long as you're playing within the rules and aren't hiding anything from the IRS. It's about knowing your options to avoid overpaying your taxes. Tax avoidance is legally reducing your taxable income by using deductions, claiming credits, and investing in tax-advantaged accounts, as allowed by the U.S. tax code. Tax evasion is concealing information about your financial situation from the IRS or other tax authorities, such as your CPA. Tax avoidance is about knowing the rules so you can keep more of what's rightfully yours. Tax evasion involves lying, hiding, and failing to report money that you owe, which is essentially stealing. Before we break down some good ways to legally reduce your taxes, let's clarify what's not legally acceptable so that the difference between the two is a bit clearer. Examples of tax evasion. Tax evasion occurs when someone conceals or distorts their financial situation to pay less tax. This is illegal and can lead to hefty fines and worse. This can include not reporting cash income, not reporting overseas income, not reporting cryptocurrency earnings, and claiming personal expenses as tax-deductible business expenses. Here are 6 ways for business owners to legally avoid or reduce taxes. Number 1. Self-employment tax deduction. The standard self-employment tax for business owners, independent contractors, and freelancers is 15.3% of your net earnings after business expenses. This covers your Medicare and Social Security contribution. The IRS considers half of this tax to be a business expense. Number 2. Deduct for business expenses. Savvy business owners take full advantage of business expenses that can be deducted from their income when filing taxes. This includes things like home office deductions, phone bills and internet, raw materials for your craft, marketing and advertising costs, office supplies, client meetings, business trips, education related to your field, and more. A detailed list of deductible business expenses can be found on the IRS website. Number 3. Contribute to a retirement plan. This is a smart way to reduce your taxable income while simultaneously investing in your future. There are a few options for freelance retirement accounts, such as a Roth IRA, a SEP IRA, and a Solo 401. Number 4. Contribute to an HSA. This is about using tax-free savings to cover medical expenses, such as doctor visit copays, deductibles, and even specific items like prescriptions, contact lenses, dental, and vision care. As a self-employed individual, if you're covered by a high-deductible health plan, COP, you are eligible for a health savings account of life. This is ideal for people who are relatively healthy and aren't likely to get sick since the deductible is higher. However, you'll have lower monthly premiums and an HSA where you can transfer pre-tax income. Number 5. Donate to charity. In 2022, taxpayers must claim charitable contributions as itemized deductions on Schedule A of IRS Form 1040 under gifts to charity, as the 2021 charitable tax deduction rules were not extended. So it's important to ask for a tax receipt anytime you donate clothing. Make an online donation, attend a charity event virtual or in person, as these are all tax deductible. Even volunteering expenses like gas mileage can be included. Number 6. Child tax credit. For business owners with children, the child tax credit represents a further opportunity to reduce their taxes. As the 2021 enhancements to the CDC has expired, for 2022, the initial amount tax credit is $2,000 for each qualifying child. As well, a child must be under age 17 at the end of the calendar year to qualify for the tax credit. Figuring out how to reduce your taxes and avoid overpaying can be complicated. If you found this video useful, please like, comment, and subscribe to stay up to date on all of our latest videos.